Hey guys, this is going to be sort of a mapping out of scenarios on the weekly log scale ES chart, reviewing the past year, what's traded, and some scenarios for moving forward. So again, log scale ES chart, and all of these fib setups are going to be log scale as well. So we've been in a channel, and I've been thinking that this was a fourth wave from the top of this third to the opposite side of the channel in the COVID crash into this fourth wave low, and that this punching out of the weekly channel has been a fifth wave. We've seen this script before in the run up to 87 and the run up to 2000. When you start punching out of weekly channels like that, really the only move left is for this fifth wave to go up in extensions. And I mean that scenario is extremely bullish because extended fifth waves go up, 150, 200%. So from here, ES 3500 at this support, you'd be looking at ES 7 to 10,000 would be the targets for an extended fifth wave, which is ridiculous. Um, so again, the anchor is over here, the third wave at the left side of the channel, highs to highs extension. And let's just get in really up close and personal with the past year on the weekly chart here. So, I'm just going to map out what's traded and then look at three scenarios. My scenarios are bearish, very bearish, and extremely bearish. So if you're bullish, this isn't the video for you. And it's not just my opinion, but it's my interpretation of this structure here. So many Elliott wave people are unhappy with what they perceive as this initial three-wave move into the low. And the thing about Elliott wave is that you can go to a smaller time frame and find almost anything you want. And I remember looking at this initial wave down on the hour chart and thinking that there was a 4 and a 5 down here. And so I still think that this was an impulse wave down and that is your wave 1 right there. All right, we came up, we had wicks through this resistance zone here, but no weekly close up there. And then we came down and wicked just shy of the 236 target. And then we came back and wicked through the 618 line here. But the weekly closes are what matters. And this setup held. This initial measured move held. There was all sorts of gamesmanship around it. And then, so your wave 1 was to here. This was your A, B, C up. And then this first move ran to its 618 target down here. This is the wave 3 wicking through the 618 target. Then the next setup that traded was this 4 and 5. And that 4 traded a simple 50% retracement of this wave, right? I'm looking at this level here, which is at 41.99, and this high was at 42.02. And the low of this wave 1 over here was at 42.12 something. So 10 points separated the top of wave 4 from the bottom of wave 1. And then that measured move ran to its 236 target. 36.98. The low here was 36.39. 36.39. Yeah, so to the tick, it hit the 236 target. And that completed a wave 1 down. And the support here is the 50% retracement of the highs to highs extension that I showed you. We did the classic 2 weekly candlestick pattern where you have 1 week down and then 1 week up. And so this is where, things get interesting. We ran from the 50% support of the extension. The B wave had wicks sort of coming off that support. And we ran in what seems like a clear 3-wave move into the 618 resistance of this full retracement of wave one down. 43.22, the high here was 43.27 something. So a 5-point dip in there. That was the August high. We hung out there for about 2 seconds. And the reason was this full retracement and this channel that had developed. I mean, everyone knows that. And so this is where things get complicated, I think, is this wave down right here. Most people are interpreting this, so this was a wave one down, an ABC up into a wave two, and that this was another impulse wave down into a wave one of three, and this was a weak correction up in a wave two of three, and that we're now in the crash wave, wave three of three going down. Christmas be damned. We're crashing right now. And that is what I have 3 scenarios here: extremely bearish, very bearish, and bearish. And this is the extremely bearish scenario. All right, we completed wave one, we did a full wave two retracement, and now we came back in, this retracement came to the 618 of the retracement of wave one. This came back to the 50% retracement of that wave one, which is all very technical, very legitimate, very valid. In that, we're just going to go down now. We are in a wave three of three, and we're not making any significant retracements back up. So the issue I have with that is viewing this wave here as an impulse wave. So to see this, we have to switch to the daily chart, and we're looking at this wave right here. Is this an impulse wave? You could easily say 1, 2, 3, 4, 5. The reason I don't like that is that this wave 4, it came too high to be an extension off the bottom of this wave right here. Right, that's a huge, like 50 or 60 point dip in. That setup didn't trade. But if we look at this wave, this is a 1, 2, 1, 2, 3, 4, 5, arguably a 4 and a 5. And so this would be the bottom of wave one, and that looks like a more sort of a normal extension to me. And it ran just a couple points shy of its 236 target. So I don't know if I'm being academic about that, but it seems like this fourth wave works better as a fourth wave for this degree of trend and not the whole thing. In which case, if we switch back to the weekly chart, we're looking at, we looked at extremely bearish, now we're looking at very bearish, right? Which is that this was an ABC up, this was an ABC down, and we've already completed another ABC up. So this was the top of wave two. But what this does is it says, okay, we're in a wave three of three, or I'm sorry, we're in a wave three, but this is just one of three. And we're going to make a wave two that is going to break out of this weekly channel in Q1 next year and create a proper trap, right? Like we had in 2001 and 2009. If we just go down from here, it's more bearish than those prior two crashes, because they at least broke out of this initial weekly log channel. So the extremely bearish scenario is the most extremely bearish scenario. And so I think I'm leaning towards this scenario, right? The issue with this scenario, what makes this so dangerous to trade, is you'll notice that every time we touch a major support or major resistance, we run completely to the opposing setup. So we went from the extension 50% support to the measured move short 618. and then we ran from the 618 to the extension, high size extension 618, and then we ran to the 50% short. And so it looks like bears are in total control. And trading any sort of move in the middle here against a touch of a major support or major resistance has been a losing strategy, right? And so in order for, well, what am I trying to say? I think so it's all I'm saying is that it's difficult to trade this retracement. And actually what I'm saying is if we go back to, well, we'll look at just the bearish scenario next. So, in order for this to be a wave 1 of 3 down, we'd have to find some support level for the wave 2 of 3. And what would that be? Well, the wave we would be retracing is the full move here, which would put, log scale support at 38.26. Well, the typical measured move stuff. So that is that scenario. And then we have just the bearish scenario, which is, where is just bearish? It's right here, right? Which is, that Y has not completed yet. That this first move up was an A, and that we're in a B wave down, and we still have a C wave to go. And that C wave would break out of this channel and come back up into this zone right here. And so the wave, the wave 1 of 3, 2 of 3 scenario says we could not break this high. We would just retest it. This less bearish scenario says that this corrective wave up isn't done yet. And so on the daily chart, what this looks like is, we've had some sort of 5-wave move up, right? A 1, a 2, a 3, a 4, and then a 5. And then if you look at RSI, everything that's happening on the daily and weekly chart is all corrective, right? When you don't get extremes on RSI, it says everything is corrective in here. And so that would mean that this is an A wave down, that was a B wave high, and this is not a wave 3, but this is a C wave down. All right, so this big wave Y would be a 5, 3, 5, which implies we're going to have another 5-wave move up into out of the channel and have a proper trap and a distribution up here in Q1. And to me, that's the most destructive scenario for most people, right? Everyone who thinks they're on board the train right now would get taken out. And so, obviously you can't even consider that scenario until we break out of the crash channel that we're in. We're in a tight 2-hour crash channel. But if we retrace some portion of this move, now we're at the 38.2, ignoring the B wave high. If we break out of the crash channel and start defending retracements, then this scenario is in play. So this is just a map of, all scenarios are bearish, but how immediately bearish is what's happening. This is what I'm trying to work out. So is that everything I wanted to say about this weekly chart? Yeah, I mean, the danger in these less bearish scenarios is that, again, every time we touch a major level, we trade across to another major level. And this is the middle of the zone. Extremely difficult to take that setup for a wave 2 or a wave 3. So for a wave 2 of 3 up, or to complete the wave Y. I am out of time. Thanks, guys.